Welcome back to the another video, and in this video we are on the chapter 18 of the book, that is future option and Bragg's model. Now we will cover what is future option, how it is different from option, and also how the Bragg's model is used in pricing of future option, currency option, and many options. And so let's start without any delay. Okay, let me get my board, and we are on our whiteboard, and we are on chapter 18, that is future option. So till now we were looking at spot option where we buy asset at its spot price, like the stock, FX rate, that is a fixed rate, right? Now there is an option on future. So future option is a type of derivative that give a holder a right, not an obligation, to enter into future contract with the set amount of future price. Bus, that's it. Future option on future option with fixed forward price, FO. So its payoff would be FO minus S. Sorry, the payoff would be FO. No, FO is initial, right? And we have a K is a fixed strike price for a future. So the future price at that point minus K and 0, and the maximum, and also the payoff from future, cash amount payoff from future. So future payment would be ST minus K, right? So that would be how it be. So now let's talk about expire expire our expiration date of option, future option. So future option expiry date is few date before last trading day of option. So let's take a timeline. So there is a expiration day, there is a trading day, last trading day, and then delivery month, right? So here is a delivery month, and it is a last trading day of futures, and then it is will be like a 2-month contract, and after 2 months there will be the delivery data. So the future option would trade few day before that, and at this point the F, the value of future contract minus ST, right, minus S, would give the maximum payoff, and then they will enter into the contract, and at D, then the final payoff would be ST minus F. So there would be two payoff plus a cash amount. That's the future work. And so in this way there is a many future options, like there is a future option on interest rate future, right? So interest rate are future that allows us to set the interest rate today or a SOFR, the 3 month SOFR interest rate. There was a reward interest rate. So there is an interest rate contract that would be payoff. There would be a strike price and then the spot price minus payoff, and there would be a notion, 100 into notion, and payoff would be like this of for a call option, call future option on stock. And yeah, the so far is forward looking, so far is backward looking interest rate, which mean that every daily interest rate is compounded and decide the so far of today. That's how so far work. And yeah, so why future option are used, right? It is a different type of option. First, it is more liquid. easy to buy futures, option on futures, then option on spot. On delivery, there is no delivery seen. I mean, all the settlement are done in cash, so it is easy for a trader to manage. And also, or the buying the future and also hedging it with spot, with futures and spot, these all are done in same market, so it is easy for a trader to hedge their position. And sometimes future options are more market than in asset underlying. Let's say treasury bond market futures, on future option on treasury futures on treasury bonds are more heavily traded than treasury bonds. That's why it is more liquid and more heavily traded use, and that's why there is option on futures. And yeah, so rover bond and the rover bond is also the same. Rover bond for call would be FO minus K ERT, and for a put it would be K minus FO discounted today, and it would be same. There is no difference. Instead of SO, SO there is FO. And for American future, it can be exercised anytime, so there would be no discounting. So there is no discounting factor here. And yeah, now let's derive the drift of futures option, futures price, drift of future price in risk neutral world. So in risk neutral world, all the return are at risk free rate, right? So we all know that our Q equal to R, the dividend, or mu equal to R. That's the risk free rate. So we know that at starting of future the value is 0, the starting of contract the value would be 0. So if we are taking small time stamp between that, that is f delta t minus f0, and its value will be also the 0 because the forward contract value at starting is 0. And then if we discount it with expectation, and because its value should be 0, we are discounting it at present time, then our total expectation is also 0. This come here and become 0, then total expectation is 0. And for this we can say that this is a delta, the value of this is this, and like this. I will explain simple term. Let's say 2 delta t, expectation of 2 delta t is equal to expectation of delta, sorry, equal to expectation and 2 delta t is equal to f delta t. So if it is a 2 delta t, its value, expectation value is previous value. That's how. And for example, if expectation is 3 3 delta t, its value would be future value at 2 delta t. And from this we can use itolemma and derive the function dynamics, and would be, sorry, so we can say that there is a new drift term, so there is only diffusion term, right? That is diffusion term, and if we apply itolemma and Black's codes and so solve it, our diffusion equation come to just a simple equation, and from this we can derive Bragg's model. And Bragg's model is used to derive the price of future option, and it is exactly similar to Bragg's course formula. I will say you only one difference there is. So there is one, first is discounting, and instead of SO there is N1 N1 D1 N1 D1 and N2 D2 and D2, right? Instead of SO there is FO, okay, and put value would be also the same, minus D1, but the only difference is in D1 where there is a no drift term. There is a no drift term. There is no mean. You can see it. Here there is half mu half term, right? There now there is no term because of and there is no drift term in our equation here, and that's the Bragg's formula. D1 and D2 is simple. D1 minus sigma or same upon sigma D na. That's the famous Bragg's formula. Okay, and it is used in deriving the value of future option and why, I mean currency option also, I guess. In commodity markets, it is used for pricing the value on futures of commodity, right? Okay, Bragg's formula is all many beneficial on an investment asset because we don't have to find the dividend yield from it, and we can price the option. Let's see binomial asset pricing model on future option. So yeah, so binomial asset pricing model are based on portfolio construction model. So where we construct a portfolio where we are short in option and long in delta future. Okay, same construction. Now the stock price is at, I guess, 30, and it can go at 33 and it can go at 28, right? That is the, yeah, and the no arbitrage say that the both return would be same. So according to that, if there is 33 and it is a core option, right? We are pricing core option, so its payoff would be 33 minus 30, that is 3 delta, okay, and minus, wait a minute, I'm doing wrong. Where is eraser? So the strike price is 29. Okay, if price is at 23, then the total value of portfolio would be minus 4 because we shorted, and delta it's from 3, so delta 3. And if it is down at 28, then our portfolio call option would be 0, and the total loss would be minus 2 delta. And we can equate this, right, for between no arbitrage condition, because and the value of delta term is 0.8, right? After that we can discount it. So we put our value in this, that is 3.0.8 minus 4, our value is 1.6, and now we discount this to a present value, at t0, and its value is 192, and it's simple binomial model, nothing's changed except of SO and FO and the strike price. Then after that, let's generalize this. So our delta, we know that FU up moment minus down moment upon FU up plus FO down, that is our delta value. And now our first portfolio, if price goes up, is FO up minus FO delta minus FU, right? And if price is down, then first we discount it. In book there is a discount, and we have a discounted value, and our short position is this, right? We short our position. Okay, and after that we simplify. After putting value of FU delta value, and the simplification comes here is, to understand this you have to look at binomial asset pricing model, and I am not covering that in detail, I'm just stating it. And it's simple: up moment minus down moment, probability of up plus probability of down moment, and discount it, and the probability value is this. And that's how you price the option using binomial model. And after that you can generate multi-step tree with volatility, right? We have a volatility tank. This is the up movement with A, B constant, right? Yeah. And traded future option American, or are American type Luxembourg, maximum are American type option. And the American futures option is worth more than American spot option on that asset because of early exercisation. The thing is, if we early exercise, let's say in between this, the future price, our payoff from this is more, right? We earn plus delta amount, and then after that we can enter into a forward contract, and our forward price is set, and the payoff would be fixed. So we can earn more money, and because of early exercisation of future option, that's why it is earn more. And similarly, future put option must be what futures put option would be what rest and corresponding because of early exercises. And yeah, that's, and the last future style option. So it is a, what we say, future contract on payoff from option. It is little bit complicated. Let me explain you in the simple way. So just a future contract is bet on what, so the futures are the bet on what the price would be, right? In future. But the option, future style option, is bet on what will be payoff from option. So it is a bet on the payoff from option, future option. That's why it's called future style option. And that's its payoff, the future price of futures its payoff is like that, like American. Yeah, there's no detailed explanation of future style option. It will be confusing, but yeah, that's the whole summary of the book, or sorry, chapter on future option and Bragg's model. I hope you understand that only difference in Bragg's model is there is no drift term. There is only sigma t square root t, I guess. Sigma square t root 2 just. And why it is used, what is future type option, why it is used, it is liquid and trader easily can pay hedge in same market, and that's why it is used. And yeah, thank you for watching this video, and I will see you in the next video. Bye bye.